Welcome to Module C1, where we dive deep into the visual language of the financial markets. This module is split into two main sections. First, we will explore candles and candlestick patterns to understand market sentiment. Then, in Part 2, we will analyze price, volume, and their critical relationship. Let us get started with the basics of a candle.
Every single candlestick, regardless of the time frame you are looking at, consists of 4 major price points. These 4 data points summarize the entire trading activity for that specific period. The very first component we look at is the opening price. This is exactly where the asset's price stood when the time period officially began.
After the open, the market moves. Eventually, the time period ends, giving us the closing price. The closing price is simply where the asset was priced at the exact moment the period finished. The relationship between this open and close is what forms the main thick part of the candle. But what exactly happened in between that opening and closing bell? That is where the highs and lows come into play. The high represents the absolute highest price reached during that period, while the low shows the lowest point. These extremes tell us how far buyers and sellers pushed the price before the final close. Now, let us look at the physical structure these 4 price points create on your screen. The thick, central section of the candlestick is known as the real body. This body visually represents the total distance between the opening and closing prices. It is the core of the market's movement for that trading session. Extending from the top and bottom of the body, you will see thin lines. The line on top is called the upper wick, or shadow, and the line on the bottom is the lower wick. These wicks show the price fluctuations outside the open-close range, revealing the market's volatility during that time. Let us walk through a quick practical example of how a candle forms in real time. Imagine the price opens at a certain level. Almost immediately, it experiences a small drop, creating the low. Then, aggressive buyers step in, continuously pushing the price upward until it reaches a significant high point. Finally, before the period ends, the price pulls back just a little bit from that maximum high and closes. This exact sequence of opening, dipping to a low, surging to a high, and finally closing perfectly draws the real body and wicks of the candlestick we see on our charts. Generally, you will encounter 2 primary types of candlesticks on your charts, green candles and red candles. These colors instantly communicate the market sentiment for that specific time frame. A green candle represents a bullish or upward movement, while a red candle signifies a bearish or downward movement. A green candle forms when the closing price is higher than the opening price. For instance, the market opens, moves around, and ultimately closes above where it started. This clearly indicates that buyers were in control during this session, successfully driving the asset's overall value upward. Conversely, a red candle is formed when the closing price ends up below the opening price. The asset opened at a certain level, but intense selling pressure forced the price down, resulting in a lower close. This tells us that sellers dominated the market during that specific time frame. Moving on to single candlestick patterns, the first major one to learn is the Marubozu. Marubozu is a Japanese word, but in English it is often referred to as a dominance candle. This name is perfectly fitting because it represents absolute, unquestioned control by either the buyers or the sellers. The defining characteristic of a Marubozu candle is extremely long body with almost no wicks on the top or bottom. Occasionally, you might see a very tiny wick, but generally they are absent. This massive body compared to surrounding candles screams strong momentum and undeniable market dominance. Let us examine the bullish Marubozu. In this scenario, the price opens and buyers immediately become highly aggressive. They push the price up continuously without any significant pushback, and the price closes at its absolute highest point. This creates a massive green body, indicating pure, unadulterated buying dominance. If you spot this bullish dominance candle forming right at a major support level, it is an incredibly strong signal. It indicates that buyers have firmly taken control of the market at a crucial price point, strongly suggesting that the price is very likely to continue surging upward. On the flip side, we have the bearish Marubozu. Here, the price opens and sellers instantly take total control. The price drops deeply and closes at its absolute lowest point for the period. The market was completely in the hands of the sellers, forming a giant red dominance candle. When a bearish Marubozu forms at a major resistance level, it serves as a powerful warning. It tells us that sellers are extremely aggressive at this ceiling and have overwhelmed the buyers. This strongly indicates that the price is likely to face a significant downward fall.
After understanding dominance candles, the next crucial single candlestick pattern we need to look at is the hammer, which is also commonly known as a reversal candle. Unlike the Marubozu, which shows continuous momentum, the hammer has a very different character and tells a unique story about shifting market momentum.
Moving right along, let us examine the hammer, which is a classic reversal candlestick pattern. When we spot the specific formation near an established support level, it strongly indicates that the price might be gearing up for a bullish reversal. It shows a critical shift in momentum that traders watch very closely. Taking a closer look at its anatomy, the hammer has a very small body and a distinctively long lower wick. What happened here is the price opened, and sellers completely took control, driving it down. But then, buyers aggressively stepped in, pushing the price all the way back up to close near its open. Context is absolutely everything with this pattern. A hammer is particularly reliable when it appears during a clear downtrend as the price approaches a support zone. That long lower wick essentially proves that the support is holding firm, and the prior downward momentum is likely exhausting itself, making a reversal highly probable.
Now let us flip that concept and examine the inverted hammer. As the name suggests, it looks exactly like a hammer turned upside down. When we see this particular shape forming near a resistance level after a period of upward movement, it serves as a strong warning sign that the price might soon experience a fall. Notice the internal mechanics at play here. The price opened, and buyers immediately pushed it higher, trying to continue the rally. However, they simply could not sustain those higher levels. Sellers overwhelmed them, forcing the price back down to close near the open, leaving behind that long upper wick and a tiny body. Next up in our single candlestick patterns is the doji. You will very often hear professional traders call this the indecision candle, or sometimes the confusion candle, and for good reason. It represents a specific moment in the market where neither the buyers nor the sellers are asserting dominance. If you look closely at the structure of a doji, the opening and closing prices are almost exactly the same. There is practically no real body at all, just these upper and lower shadows. This tiny footprint visually represents a complete standstill, a perfectly balanced tug-of-war between market participants. Trading the doji requires a specific strategy, especially when it forms at a top resistance level. Because it inherently signals indecision, you must wait for confirmation. If the next candle closes below the doji's lowest point, you can confidently look at the sell side. Conversely, a breakout above the upper wick suggests buying. The exact same logic applies when a doji forms down at a lower support zone. It still means nobody is aggressive yet. However, if the price manages to break above the previous high after this support doji, it gives us a solid confirmation to start looking at buy-side opportunities as we move into our next set of patterns. Moving right along to the psychology behind single candlestick patterns, let us look at the Marubozu. When a bullish Marubozu forms, it shows buyers are in complete control from open to close. However, entering a trade requires patience. A trader should wait for the next candle to break the previous high to confirm the trend. Conversely, a bearish Marubozu indicates intense selling pressure, warning of a potential price drop. The hammer and inverted hammer tell a story of struggle. With a regular hammer at a support level, sellers push the price down, but buyers aggressively drive it back up above the open. An inverted hammer at resistance shows buyers trying to push up, failing to sustain the momentum and closing lower, which often signals an upcoming drop. Then we have the doji. This single candlestick represents pure indecision in the market. Neither buyers nor sellers are aggressive enough to take control, resulting in the opening and closing prices being nearly identical. It is a moment of hesitation, often requiring the next few candles to reveal the true market direction.
Now let us examine double candlestick patterns, starting with the bullish engulfing pattern. This formation typically occurs at a support level. It begins with a small bearish red candle, immediately followed by a powerful bullish green candle that completely engulfs the previous one.
This engulfing action is a strong indicator that buyers have violently taken control from the sellers. The closing price of the green candle is significantly higher than the opening of the red one. When spotted in a support zone, this pattern strongly suggests that the price is preparing to surge upward.
The exact opposite occurs with the bearish engulfing pattern. Found at resistance levels, which are active selling zones, this pattern starts with a small green candle. The subsequent red candle is massive, entirely swallowing the green one and breaking below its previous low.
Seriously, this indicates a sudden and aggressive shift in momentum. The market, which was previously rising, is now entirely dominated by sellers. Recognizing this pattern at a resistance ceiling is a critical warning sign that a significant price drop is highly probable. Another fascinating double pattern is the tweezer bottom, which forms in support zones where buyers wait aggressively. The first candle is bearish, showing sellers pushing the price down but failing to hold it. The second candle opens near the previous close, dips down to the exact same low, but is pushed back up by buyers. The matching bottoms of these two candles are the defining feature. It shows that sellers tried twice to break a specific price floor and failed both times. This double rejection at a support level is a reliable indicator that the price is ready to reverse and climb higher. Conversely, the tweezer top pattern appears at resistance levels, where sellers are actively defending the zone. The market is in an uptrend, and the first bullish candle hits a high point. The very next candle attempts to push past that exact same high, but is immediately swatted down by sellers. Notice how the tops align perfectly. Buyers are completely absent above this line, and sellers are in total control of the rejection. Closing significantly lower than the high, this pattern screams that the upward momentum is exhausted and a downward reversal is imminent. Moving to triple candlestick patterns, we encounter the morning star. This is a powerful bullish reversal pattern found during a downtrend at a support level. It consists of three distinct phases. The first is a large bearish candle, showing sellers are still confidently driving the price down. The second phase is a small indecision candle, where the downward momentum abruptly halts as sellers become hesitant. Finally, the third candle is a strong bullish green candle that closes well above the midpoint of the first red candle. This confirms that buyers have flooded the market and a reversal is underway. The bearish counterpart is the evening star, which forms at the peak of an uptrend near a resistance level. It mirrors the morning star psychology but in reverse. It begins with a strong bullish candle, indicating buyers are in full control and pushing prices higher into the resistance zone. Then confusion sets in with a small middle candle as sellers begin to push back. The drop is sprung on the third candle, a massive bearish drop that closes significantly below the midpoint of the first green candle. This confirms sellers have taken over, signaling a sharp decline. Another bullish triple pattern is the three white soldiers. This formation is typically spotted after a period of falling prices, right as the market hits a strong demand zone. It features three consecutive large green candlesticks, each opening within the body of the previous candle and closing higher than the last. The wicks on these candles are usually very small or non-existent, which is the key takeaway here. It represents a steady, undeniable march of buyers entering the market. Each progressively higher close indicates sustained buying pressure, strongly suggesting the upward trend will continue. On the flip side, we have the three black crows. This is a severe bearish reversal pattern that occurs at high resistance levels during an uptrend. It consists of three consecutive large red candlesticks, where each candle closes progressively lower than the previous one, showing relentless selling pressure. Seriously, the defining characteristic here is the absolute lack of buyer intervention. Sellers are dictating the price action entirely. When you see these three cascading red candles at a resistance ceiling, it is a glaring indicator that the market sentiment has violently shifted downward. While these candlestick patterns are incredibly useful, trading solely based on them is a recipe for high failure rates. A pattern might work perfectly one day and fail the next. The secret ingredient that makes these patterns reliable is context, specifically their location relative to support and resistance zones. If a reversal pattern forms exactly at a known support or resistance level, its probability of success skyrockets. In the vast ocean of trading indicators and strategies, the market only provides two truly original pieces of data to work with: price and volume. We will explore how these fundamental elements tie everything together next. Moving right along to the core mechanics of the market, we must understand that there are only two truly original factors provided by the market itself: price and volume. Everything else you might use on your charts, indicators like MACD, RSI, Bollinger Bands, or tools like trend lines and Fibonacci, are entirely derived from these two foundational elements. Even advanced strategies like smart money concepts or breakout strategies rely entirely on the raw data generated by price and volume. If you strip away all the noise and complex overlays, These two metrics are the absolute truth of the market. Understanding them in isolation gives you a massive analytical advantage. Now, a very common mistake newer traders make is misinterpreting how volume is traditionally displayed. Most charting platforms show volume bars in bright green and red. Because of this visual cue, people naturally assume that a green bar means there are more buyers, and a red bar means sellers are aggressively taking over. But this is a fundamentally flawed concept. Volume does not inherently mean buyers or sellers based on its color. The color usually just reflects whether the closing price was higher or lower than the open. Volume simply represents the total number of transactions during that specific period. This brings us to a crucial point about market manipulation. Smart money, like large banks and institutional investors, can relatively easily manipulate the price of an asset to trap retail traders. However, manipulating volume is incredibly difficult because it requires massive amounts of actual capital to be deployed simultaneously. For example, if large players push the price higher but the volume remains below average, it tells us the upward move lacks genuine market participation. The price simply cannot sustain itself at those highs without real volume backing it up, which almost always leads to a sharp and sudden fall shortly after. Let's clearly define what volume actually is in the context of the market. Simply put, it is the total number of shares or units bought and sold within a specific time frame, whether you are looking at an hourly, daily, or weekly chart. It is the exact verifiable count of transactions that have successfully taken place. Imagine a bull holding 1,000 shares who wants to sell, and a bear who wants to buy them. When the bull sells those 1,000 shares to the bear, the total volume generated is exactly 1,000. Many beginners mistakenly count the buy and the sell separately, thinking the volume is 2,000, but it is only the single transaction of those specific shares. Ultimately, volume reveals the true level of interest from both buyers and sellers at a specific price point. When the market reaches a price level where participants are highly interested and aggressive, you will see incredibly large volume bars form on your chart, confirming that heavy capital is stepping in. Conversely, if the current price does not interest the broader market participants, the volume bars will shrink significantly. This lack of aggression means neither buyers nor sellers are willing to commit capital at that specific level, leading to those small, quiet volume periods where the market essentially waits for a better price. To apply this practically, open up your charting screener, navigate to the indicator section, and simply type in volume. It is usually the very first built-in option that appears. Once you add it to your chart, you will see those default colored bars appear at the bottom of your screen. Because the red and green colors cause so much psychological confusion, I highly recommend going into the style settings and changing both the growing and falling volume colors to a neutral black or gray. This immediately removes the subconscious bias of associating a green bar with buying and a red bar with selling. Additionally, make sure to enable the volume moving average in those same settings. This line calculates the average volume over a set period. If a volume bar pokes above this line, you instantly know the transaction activity is higher than average, and if it is below, the market is quieter than usual. Let's look at a fascinating phenomenon called volume divergence. Suppose you see an absolutely huge volume spike on your chart. Naturally, high volume means heavy buying and selling has occurred. But if you look at the price candle and it hasn't moved at all, something highly unusual is happening behind the scenes. Following that massive volume with no price movement, you might see the price rise briefly, hit a high, and then fall into a sideways range. During this sideways period, if the volume becomes completely dry and drops well below the average line, it strongly indicates that the current trend has exhausted itself, setting us up for what comes next. Let's explicitly break down the 4 fundamental types of volume divergence. First, if the price is rising and volume is also rising, buyers are highly interested. This indicates strong momentum and suggests the price can continue to climb. Second, if the price is rising but volume is falling, it means buyers are no longer interested at those higher levels. The asset might be overvalued or overbought, and this lack of genuine buying pressure warns of a potential price drop. Third, when the price is falling while volume is rising, it signifies that sellers are highly aggressive. This often occurs near resistance levels, signaling that the downward momentum is strong and the price could drop even further. Finally, if both price and volume are falling together, it means sellers are losing interest at that lower price point. When this happens, especially near a support zone, a price reversal to the upside is highly likely as sellers exhaust themselves.
You could apply these volume divergence concepts to almost any trading approach, especially breakout trading. If you are watching a sideways market and the price suddenly breaks resistance, you absolutely must look for volume confirmation. A breakout accompanied by a massive surge in volume means the move is genuine. It is driven by real buyer interest, indicating the price is very likely to sustain its upward momentum.
This volume confirmation is your green light. It proves that the breakout isn't just a fake out, but rather a structural shift supported by actual capital flowing into the market.
Conversely, consider a chart where the price is steadily climbing, but the volume bars are actively shrinking. This specific divergence tells us that the current market price is no longer attractive to the broader pool of buyers. Without that underlying volume to support the rally, the price simply cannot sustain its upward trajectory, and a sharp fall is usually imminent.
Whether you trade using smart money concepts, breakout strategies, or simple support and resistance, volume acts as your ultimate validator. While price action can sometimes be manipulated by large players using fake supply or spoofed orders to trap retail traders, volume is predominantly genuine. It represents the actual, undeniable footprint of executed trades in the market.
To wrap up our comprehensive look at market dynamics, remember these key takeaways. Volume is the engine that drives price. It always validates whether a move is genuine or a trap. By mastering the 4 types of volume divergence, you can anticipate market reversals and confirm breakouts with significantly higher accuracy. Integrate these volume concepts into your preferred strategy to trade with much greater confidence.